Good afternoon, and welcome to our Employee Benefit Plan webinar. My name is Alexander Reyes, a partner and financial services practice leader for Citrin Cooperman. Very excited to moderate today's panel. As everyone knows, COVID-19 has required many to adjust to the new normal. Its impact has been felt globally and across industries. For today's agenda, we'll concentrate on some key issues affecting EBP plans, including the impact that COVID-19 has had on plans and its participants. We'll discuss the CARES Act and your retirement plan, fiduciary responsibility and evaluating investments during volatile markets, managing participant anxiety during market downturns, top 10 most common errors, and we'll leave some time also for Q&A. Today, I'm joined by two incredible leaders in the industry, John Ilsenio, a partner and EBP and not-for-profit practice leader for Citrin Cooperman, and Tiffany McGee, partner, CEO, and co-CIO of Institutional Investment Services for Momentum Advisors. Thank you for joining us. So I'd like to start by asking Tiffany to walk us through the CARES Act and how it affects your retirement plans.
Thanks, Alex, and thanks to you and your team for organizing this. So let's first just kind of review some of the details of the CARES Act, and I'll just forewarn everybody that this first piece is a little bit data heavy and detail heavy, but I promise we'll get to some fun stuff a little bit later on. So on March 27th, the CARES Act was signed into law, and its official name is the Coronavirus Aid, Relief, and Economic Securities Act. So we are clearly in unprecedented times, and so the economy as a whole is having to make adjustments, and this includes your retirement plan. So we're going to talk a little bit about how the CARES Act is affecting your employer-sponsored plan. Next slide. So just to be clear, the types of plans that we're talking about here that may be impacted are 401A plans, including 401K plans, 403A and 403B, as well as the government plans, 457B plans. Next slide. Can you make this a little bigger? Just want to make sure everybody can see. So this is basically a cheat sheet of all the details of the plan. And we are going to be sending this out a little bit later, so you guys can all have a record of this. But there are withdrawal changes. There are some updates to RMDs, the required minimum distributions, some loan changes, and some overall plan changes that I'll kind of go over with you right now. So with regards to withdrawal changes, so this, we're talking about your participants coming and wanting to make withdrawals from the plan. So tax favored withdrawals, penalty free withdrawals are allowed, distributions up to $100,000, and that's between January 1st and December 31st of 2020. And so, you've probably been watching the news, and there's talk about another stimulus. So right now, that time period is the case. That may be extended, and we're watching very closely. So what I'm going over right now is for today. This could all change tomorrow, right? But for right now, that is the time period through December 31st, 2020. So in particular, we're talking about a coronavirus-related distribution, and what this is, right? The definition of this is a distribution that's made to an individual that's either one, who has been diagnosed with COVID-19, two, whose spouse or dependent is diagnosed with COVID-19, or three, who experiences adverse financial consequences as a result of being quarantined, furloughed, laid off, having their work hours reduced, being unable to work due to lack of childcare. This is a pretty broad definition. Closing or reducing hours of a business, owned or operated by an individual due to COVID-19 or other factors. And really those other factors, it says that is determined by the Treasury, by the Treasury Secretary, but this is a broad definition, right? I would argue that everybody on this call, could somehow fit into this category, right? But there is an actual definition. So the repayment of the coronavirus-related distributions are permitted when within 3 years of taking the distribution, right? So they're giving you 3 years to pay this money back. Distributions, again, the only thing we're talking about here are coronavirus distributions. They may be included in the individual's taxable income over a 3-year period, right? So they're allowing you to stretch that out. And, again, this is so that the individual taking the distribution will not have to pay taxes on the entire distribution in a single year, right? This is a big difference from a traditional distribution. So the mandatory 20% withholding is not going to apply, right? So typically when someone takes a retirement distribution, there's that automatic 20% withholding for federal taxes, and this is going to be waived in this case. So moving on to required minimum distributions, or RMDs. RMDs may be waived in 2020, and including those who have not received their first distribution if they turn 70 and a half in 2019. So remember, you've got to take, a participant has to take, an individual has to take an RMD the April after they turn 70 and a half, right? So a plan or IRA beneficiary receiving distributions over a 5-year period will be able to waive the distribution for 2020. So moving on to loan changes. So plan loan dollar amounts will be temporarily increased to the lesser of $100,000 or 100% of the participant's vested balance, right? So this applies to loans taken within 180 days of the enactment of the CARES Act. And then, we're still waiting, for additional guidance from the DOL on 100% use of account balances. So 1 year delay, there's a 1 year delay for loan repayments due in 2020 with a subsequent payment adjusted to take into account the delay. So if you had participants that already had loans, right, prior to this, there is going to be a 1 year delay. And loan durations, including the 5-year maximum, may also be disregarded during this period if the payments are delayed. So just something briefly on plan changes. So plan amendments for coronavirus-related distributions. This includes RMD waivers, and increased loan limits. Again, all of this is optional. Will be required by the last day of the plan year, beginning on or after January 1st, 2022. With an additional 2 years for the government plans. So I'll stop right there. I know I just covered a lot. We can move on to the next slide. And by the way, we're going to have questions at the end too. So make note your questions.
Perfect. Thank you, Tiffany. And I guess, John, just shifting to you, anything before we move on to this slide, anything you'd like to add as far as the CARES Act?
I think everything Tiffany said is spot on. There's a couple of things I think I would like to add on to as it relates to that qualified individual, that QI as they're calling it. The explanation and the criteria did evolve from the initial enactment in March. And so the IRS did put out a notice. It's out there as notice 2020-50. Again, it did amend and expand the QI qualification. So do read that, because members of individual households is a new addition and was clearly defined, as Tiffany mentioned. And that really is someone who resides in the principal's residence of the individual impacted by COVID. As we said, these self-certifications for COVID impact, for the distributions and the loans and all the provisions that Tiffany mentioned are self-certified. So there was a little bit of clarification because of the ambiguity that existed in there that talked about what the responsibility of the plan sponsor is in documenting that self-certification. And the latest notice that came out said that the eligibility can be based on a self-certification from the qualified individual, unless there's knowledge at the plan sponsor level contrary to that certification. Now, that doesn't mean that you need to go out and inquire or ask, but if you have prior knowledge for the participant that would lead you to doubt that self-certification, it does need to be questioned. So a little bit more clarification as to the plan sponsor's role in that. From a repayment on the hardship distribution, the couple of things, the favorable treatment of that 3-year period, I think is beneficial to the participants. From a record keeping perspective, I've heard some plan sponsors just double check with your record keepers to make sure that they're set up to be able to take in those repayments if they're so elected to be done over the 3-year period. I know that most of the record keepers have that ability to do that, but some of the smaller ones that are out there may not have that option. As Tiffany mentioned, the 20% withholding is waived. There has been some discussion about that default 10% withholding as well. And I think the notification to participants on the potential to waive that as well is something I've heard plan sponsors trying to get out, especially in light of all the additional penalties that the Secure Act that was enacted in December of 2019 implemented to avoid any potential additional penalties and liabilities. The $100,000 limit is a maximum distribution. So to be clear, I just wanted to emphasize that the combination of the 3 or 2 or any other programs that you have has to be maxed out at 100. That doesn't mean you can pull 100 from each plan that you may be in, whether it be an IRA and a 401k. It has to be done in totality. And I think just from an overall perspective, really understanding that these provisions are optional. As Tiffany mentioned, they're optional, but they're also mutually exclusive, right? So these adoptions can be done part and parcel from the way that the law is presented. For example, a hardship distribution can be accepted or adopted by the plan through an amendment, but that doesn't necessarily mean that you need to adopt the loan provisions of this. Furthermore, if you adopt the hardship provision from a distribution standpoint, that doesn't mean that the plan has to allow for the adoption of the repayment provisions if it's contrary. So again, some thought needs to go into what amendments, what options do you want to implement in order to accomplish this. I think that a best practice at this point is really to look at your demographics, look at your participants, and see what is the better route. I've heard some sponsors talking about looking at their plans, and is it better to offer your partner or adopt the loan provisions, which have no taxation at this point, versus the hardship distributions? When you contemplate that, if you're not going to offer both, hardships, although it's more favorable to be able to spread these payments over 3 years, you need to consider the ramifications and impact for the employees later on. If you decide to just offer loans, there may be potential tax and penalty if those loans default in future years for your participants. So really understanding and adopting these provisions and how they would best apply to your demographics and participants is going to be necessary. I know a lot of plans, I was doing some research and some surveys that have been out there, and some of these larger plans have already, about 60% of them have already adopted some form or actionable item on these provisions. And a lot of them are really leaning towards the hardship distributions, although a 50-50 split on the loan implementations as well. So I think it's encouraging to see that so many have already stepped up into this, and that even for smaller plans, there's been some discussions already about adoptions and how to help their participants. More encouragingly, there's been a study through May of 2020 that's participants and borrowers and savers are still continuing to contribute to their plans, and hopefully that's a good thing. The provisions of the CARES Act was done to help with the liquidity functions for our participants and things along those lines. But the one thing that you always wrestle with is once you take distributions and pull funding out, is there an ability to retire 5, 10, 15, 20 years, whatever your horizon is, and be able to do so comfortably, or will we have an additional issue that this pandemic has caused? So those are just some thoughts I had on the topic as well.
No, that's perfect, John. Thank you for that. Now let's shift, John, to a different topic. Can you share your thoughts on fiduciary responsibility as it relates to plans?
Sure. So, fiduciary responsibility, really, next slide, Elisa, please, basically highlights the governance function. And when you think about it from a board of directors perspective, it's really no different than looking at the governance and tone at the top that you set for any other matter that you're involved with. Looking at plan funding, looking at the design of the plan, how it's going to impact your analysis and valuations, looking at your investment management as well as your trustees and reconciliations and reporting, and more importantly, your compliance, both from an ERISA standpoint or a revenue standpoint, revenue coding standpoint, or understanding how you communicate with your employees are always top of mind, or responsibilities that boards and plan sponsors should be considering. I think when you look at plan sponsors, they really do understand their fiduciary duties, and they understand their responsibilities to administer the plans. But there's been a number of class action lawsuits. There's always scrutiny from the Department of Labor and Internal Revenue Service on various matters, in particular as it relates to fees, and I'm sure Tiffany will speak on that in a little bit as well. So the call to action is just to be more vigilant as a plan sponsor and more proactive in ensuring that all members understand their fiduciary responsibilities and obligations to oversee the retirement plans. From a high level standpoint, you need to be able to act solely in the best interest of the plan participants and beneficiaries. You need to be able to defray plan expenses in a reasonable manner. Now, that doesn't imply that you as a fiduciary understand what your plan expenses and costs are as you're managing the information. Being able to comply with your plan document. A little bit later on, we're going to talk about some risks and top 10 findings, but the plan document and understanding all the regulations and changes that occur on an annual or monthly basis, as we've seen recently, are things that need to be factored in, as well as being able to manage and act with care and skill and diligence in your transactions, being able to make decisions that a reasonably prudent person would make in the same framework if you were to be questioned is something that is very important. And I think just a couple other things as they relate to responsibilities over the plan and the investments, options for prudently managing your investments and your options are things that are always top of mind as it comes to fiduciary responsibilities. Next slide, please. So this depiction really is just a couple of high-level things. Again, plan sponsors should have reputable advisors and providers in the context. So I think when you're engaging with your third parties, when you're looking at your advisors, make sure that they really are qualified and have the expertise to guide you on all matters, that they're providing you with timely information and data so that you can make prudent decisions as you go through. I think having minutes available that discuss and document any regulatory changes, updates, how you envision the plan evolving or morphing based on these new regulations, and documenting your analysis of costs and fees is a best practice that many do, but for those that don't, definitely needs to be put into place. And just communication. I think the pandemic's really focused in on communication overall and the ability to communicate not only with your advisors and the board and the plan sponsors, but with your participants. They're experiencing great turmoil possibly, and they're seeing erosions in the markets. And, this is the time when plan sponsors need to step up the communications and make sure that you alleviate or calm some of the fears that might be out there and how you're managing the portfolio. And with that, I'd like to turn it to Tiffany now to talk about some of the additional risks.
Perfect. Well, thank you, John. I guess Tiffany, to John's point, what about investments and plan sponsors' fiduciary responsibility?
Sure. I think we're on the next slide. Yeah, so and John actually, mentioned lawsuits and things like that. So I'm gonna just kind of touch on that. So what I'm going to talk about is, definitely under ERISA, there's some things that we're going to go over. But I want to, for everybody who's on the call, I don't want them to separate ERISA, non-ERISA plans in their head. And here's what I mean by that. So, ERISA has a very, set guideline in terms of what plan sponsors must do. There are some non-ERISA plans out there, and that does not mean that if your plan is not an ERISA plan, if you don't have to comply with ERISA, it doesn't mean that you don't have to do any of these things, right? You should have a set of best practices. You are still regulated in most cases by the states. And so you do have a fiduciary responsibility to do things in the best interest of your plan participants. So being a non-ERISA plan does not absolve you from your fiduciary responsibilities, but it does, in a lot of cases with some of these lawsuits, they use ERISA as like a best practice, right? Because for non-ERISA plans, again, there isn't a specific, set of like, very detailed rules like ERISA, but there are definitely some guidelines that you should follow. And they often kind of look to ERISA for best practices. That's what we've seen. So the first thing, plan sponsors need to have a documented process for selecting, monitoring, and removing funds from their platform, right? And so, from our work with plan sponsors, no matter how big their plans are, they tend to have a few characteristics, right? That retirement plan tends to be housed somewhere out of HR, right? And even though their plan may be $300 million, $400 million, $200 million, or even, $10 million, there tends to usually be one or two people that are tasked with the responsibilities, the day-to-day responsibilities of administering that plan. Again, usually the people that we're working with, the plan sponsors that we're working with, don't have a separate dedicated team just to manage the retirement plan, right? They don't. So when you're dealing with maybe HR professionals, right, who administering the plan is one of many responsibilities they have, right? And now ERISA or the powers that be have asked them, hey, listen, you should have a documented process for selecting, monitoring, and eliminating funds from your platform. Well, where do you pull from that, right? So that's a very interesting thing, and a lot of plan sponsors have questions, right? So I'm an HR professional. This is what I do. I know employee benefits very, very well, but now you want me to pick investments, right? The other thing that ERISA says in particular that plan sponsors have to do is to ensure that all plan fees are reasonable. And so that's kind of like a relative term, right? So what does reasonable mean? And there are a multitude of fees on a plan. There are record-keeping fees. There are the fees of the underlying investments. And then there, and it gets pretty nerdy after that, 12B1 fees and all of those things. And I would argue, this is what I do for fun. I am admittedly a nerd, but most, plan sponsors that I talk to, even though they are very knowledgeable about the space, can't really tell me exactly how much their plan cost, right? They can send me a 408B disclosure, but they can't tell me the difference between, how much they're paying for their record keeping cost and the underlying investments overall. They may not be able to do that, right? Even though they're very good at their job. And so how do you determine if the fees of the plan are reasonable, right? And so I always use this example. I might, walk into a store, right? And I might say, I might be looking for a shirt and I might see a shirt and I like the shirt and I have $100 in my pocket and I walk up to the sales lady and I say, hey, I would love that shirt. I have $100. Is that enough? And the sales lady says, yeah, I'll put it in a bag for you. Great. First of all, I never asked how much the shirt cost. And I also might, another store may have that shirt for a different price. So there is no set, definition for or explicit language that at least ERISA lays out to explain to plan sponsors how exactly you can determine whether your fees are reasonable. So a best practice is to benchmark, right? So you want to definitely look at fee benchmarking and compare your plan fees to like plans, but you first have to know what they are. And so I want to make a distinction between how much a plan sponsor pays, right? How much the plan is paying for the, for all plan fees, and how much it actually costs, right? And so, new regs came out, actually went into effect, way back in 2012, I believe. And so all of the lawsuits that John was talking about, a big issue is excessive fees, right? So how do you determine if the fees are reasonable? Okay, you benchmark, but how do you know what you're paying? How do you know if you're overpaying? Because conceptually, your participants every 2 weeks or every pay period, they're making their contributions. Those contributions are going into, mutual funds that have an expense ratio, and that those payments are generating revenue. So what if your record keeper says, hey, to administer this plan, it's going to be 20 basis points. What if the plan generates more? Number one, how do you know? And number two, what happens then? And so ERISA allows for what's called an excess revenue account, in which if the plan generates more than the cost of the plan, all of that money can get dumped into an excess revenue account for the plan sponsor to use for the benefit of plan participants. I would say that not all record keepers, right, and I'll reserve judgment on this, have excess revenue accounts. There are some big ones, right? And I will not name names that don't have excess revenue accounts. So what do you do with that? And so I think down the line, we're going to see some issues with that, with record keepers that do not offer excess revenue accounts. But these are the questions as a plan sponsor you need to be asking, because at the end of the day, the record keeper is not a fiduciary. You are. And you always have to make sure that every single portion of the fee is reasonable and that everything is acting for the best interest of your plan participants. And you also, should have a diversified investment offering. There's this little rule called 404C, and in plain English, I'm sure John could probably explain it in a little bit more technical way than I could, but in plain English, it says if your participants are able to direct their own investments, right, as in most of these plans they are, if you provide them with investment education, right, some basic investment education to help them make good decisions, that's kind of offers protection to you as a plan sponsor from the plan participant coming back and saying, hey, I didn't know what to pick, and it's my plan sponsor's fault, so I'm going to sue them. So that offers you some protection. So you need to also make sure that you are, and there are actually guidelines, with in particular ERISA that actually kind of denotes what is a diversified investment offering. And so you want to make sure that you're following those guidelines, and you also need to make sure whoever is filling out your Form 5500 is doing it correctly. Don't check that 404C box if you're not doing that, if you're not providing education. So I just wanted to kind of definitely mention that. So we can go to the next slide. So just some best practices. Again, I mentioned that a lot of our clients, one thing that they have in common is there is a very small amount of personnel who are tasked with the responsibility of administering the plan. And so, fiduciary responsibility is very serious, right? Participants can come after you personally if they feel that they've been wronged. So to protect yourself, you should, spread that risk, right? There's no reason for one person to really hold all this burden. Now there definitely is a definition of who is a fiduciary, but I think the one piece is that you should create an investment committee, right? And that really, helps you to have a team of people that you can at least talk to, even if those, people aren't necessarily, totally connected to the plan. But it gives you a group of people that you can have conversations with that are aware of, your company, your organization, what have you, and to help you make decisions and to kind of spread that decision making out. And the first thing you need to do is create an investment policy statement. And a lot of people think about an investment policy statement as something you would do for a big foundation or an endowment, and that's correct. But for a retirement plan, you should absolutely have one too, right? It might be a little bit different, but number one, it will name the fiduciaries and their responsibilities, the responsibilities of the committee, how they'll make decisions. When you start to get into making investment decisions, you should have a policy in terms of like whose responsibility is it? Who does the buck stop with? Is it the committee's responsibility? Is it one person's responsibility? Is it, if you've got a board, is it the board's responsibility? And how are those two groups going to work together? And then, of course, creating, this documented process for fund selection and monitoring. And let me tell you, before I get into what a documented process is, let me first tell you what it is not. What it is not is a conversation with your record keeper and they say, hey, here's a list of funds that are good. That's not a documented process. And what it is not is the record keeper, the plan record keeper sends you something saying, hey, we are, this is what's going on with this investment. Or in addition to record keeping your plan, we also have funds, proprietary funds on your plan. And why don't you just use our funds on your plan? You've got access. I'll give an example. Let's say that you're with TIAA and they have, American Century Investments, right, on their platform. TIAA's got about over 5,000 potential investments on their platform, but they also have their own proprietary funds. So what it is not is TIAA sending you a list of their funds, their proprietary funds, and saying, yeah, these are great. Here are all the performance numbers, and you can take a look at that, and this is a good suggestion. No, it's not. So you want to be careful about that. So let's get in now to what is a documented process. You can go to the next slide. And I also want to note here that, again, during this pandemic that we're experiencing, I'm always aware that at the end of the day, these are what we're talking about as it relates to defined contribution plans, really is people's hard-earned money, right? Your participants come to work every day and they work hard. They get up in the morning, they leave their families. Now they're probably just, going into their office, home office, hopefully working from home, but this is their money, right? A little bit out of their paycheck every single pay period in hopes that, one day they will be able to have a dignified retirement. And so I'll just like to note that, the retirement plan is often, does not tell you when it's broken. It doesn't cry when it's broken. So you typically don't hear it. And it's probably one of the last things that an organization will look at in terms of things that they need to work on. And no one, if you are in HR or even in the finance office, you're never going to get a call from a retiree that says, thank you so much for that awesome retirement plan. It allowed me to retire. You're probably not going to get that call, right? So how do you evaluate whether the plan is on track? How do you figure that out? How do you know if you're doing a good job, if you're making good decisions, especially when it comes to investments? And, right now people are scared, not necessarily right this second, but in March, people were probably really scared, looking at their retirement plan balances and seeing everything go down, seeing red. And, that does not feel good to anybody. So how do you kind of implement this documented process? And so the one thing I will say is that, and ERISA clearly states this, is that if you are, a plan sponsor and you are do not have an expertise in investments, that you should hire someone. That doesn't mean you have to hire someone. You don't have to. And there are a lot of our plan sponsors, and I know a lot of plan sponsors that are incredibly intelligent. You would be if you kind of got to that point, but that also know investments. Some of them may have a background in investments, and they're able to do that on their own, and they're totally happy with that. And there's nothing wrong with that. But if you don't feel that you have enough expertise in investments to make investment decisions, ERISA clearly says, go ahead and hire someone, right? Because not knowing is not an excuse down the road. So this is kind of like our system that we use. And so we evaluate all plan investments, right? Using kind of two things. First of all, we score them, right? We use a peer, we look at them against their peers, and we also look at them against a benchmark, right? And we evaluate them using 11 different criteria. And you can see them, you can see the criteria right here. So we look at inception date, we look at manager tenure, we look at assets, how much in assets they have. We look at the composition, the style. We also clearly look at fees, right? I just spent quite a bit of time talking about fees. And then we look at risk measures, right? So alpha and Sharpe are measures of risk. Other risk measures that we might look at in addition to this is R-squared and standard deviation. And of course, we look at 1, 3, and 5 year performance. I want to get people out of the practice of just looking at performance because that does not tell the whole story, right? We want to, and just evaluating an investment against a benchmark is not accurate either. So we do both. We look at an investment against the benchmark, and again, as against its peers. And that tells us a bigger story, right? So if I was just looking at an investment's performance in March, I would say, oh my gosh, this investment is horrible. Should I kick it off the platform? Well, all investments were horrible in March, right? We're talking about mutual funds and ETFs mostly on retirement platforms, right? We're talking about these funds, and so everything was basically down. So that's why you don't solely look at investment performance. So I want to know, exactly, why is it down? And so if we take the speaking of TIA, right? If we take the first piece here, right, under large cap equity, TIA quant large cap growth, this is the current score is 0. So let me explain how the scoring system works, right? And this is just how we do it. There are a number of different ways to do it. There are other advisors that have their own methodology, and that's totally fine. And so what we do is we assign scores from 1 to 0, from 0 to 100, just like golf scores. And the lower the score, the better. And we also assign it a color. And the color helps us really communicate with plan sponsors. And it says, okay, well, green, probably good. Yellow, maybe there's something we should really look at here. And then red, maybe there's a significant issue with this fund. And then we have a process, right? And so right here with the TIA, the first investment, the TIA quant large cap, wow, the current score is 0. We like that. And if you move a little bit along, this 1 through 11 criteria corresponds to those criteria at the top that I just spoke about. Right? So a check mark means everything is good. If you go down to the last fund, that Goldman Sachs Large Cap Growth Insights, well, okay, my eye is drawn to that right away. I can quickly look at the fact that might be an issue, right? So the current score is yellow. It's a 54, so it's pretty high. And then I can look at the 1 year, right? This is like an average kind of rolling score, and it's 62. Okay, and let me kind of move along. And so what was the issue with this investment? Oh, it failed in metric 7, 8, 9, 10, and 11. Okay, that gives me a good story and gives me a little bit more insight. And by the way, just because something is yellow does not mean that we're kicking it off the plan, right? What this tells me is that the score is getting better. It was a 62. Remember, higher scores are worse, and now it's a 54. So now it's getting better. So getting back to the investment policy statement, you have to have a process for when you will remove investments from the platform, right? And so this we put on a watch list according to this particular client's investment policy statement, but you have to have a set process for when you will remove funds from the platform. And what that helps you to do is, in times of volatility, not make decisions based on emotion and not make decisions based on groups of participants having a particular issue or being a little bit vocal about a particular fund. Next slide. And next one. So again, in thinking about who our clients are and who our plan sponsors are that we work with, these are people that in a pre-COVID environment are sitting in offices, and participants may kind of walk past, right? And you may be the person who everybody knows works with a retirement plan, and so you may be like the first line of all of these participants, of all this participant anxiety, in particular in a market where things are going down. So, I really just want to take a step back really quickly and just say that, it's really important to know your participant demographics, right? One of the things that we track investment allocation data. We look at things across gender. How are the men saving versus the women? How are they allocating, right? And I can give you a quick example. In one, with one client, we were able to see that, okay, the women are saving earlier than the men, right? But then when the men get to retirement, closer to retirement age, they've got more in their accounts, in their account balances than the women. So what that tells me is, okay, let me look a little bit deeper. All right, well, how are they invested? Well, the women were making very, very safe and smart decisions, and the men were taking, and I hesitate to use the word safe, right? So more so bonds and like cash investments, right? Which was not keeping up with inflation. And the men had a higher allocation to stocks. And so then we were able to kind of go in and say, okay, well, maybe we should, bring in some kind of like some workshops with women and really have them be a little bit more comfortable with selecting investments in their platform. So the record keepers have a lot of tools like this. Your record keeper has a ton of data and should be able to give you this information. So these are the things you should be really looking at. So number one, that you know your participants. And I would also say you should have an education policy statement in the exact same way that you have an investment policy statement, and that will outline what types of events you will have, how you will kind of administer participant education to your participants. And one of the things that we've done with clients is host like event-specific group sessions. We hosted some things like what we're doing today with groups of participants to talk to them about the investments on their plan and how they can manage things, and really not to get scared and sell everything and go to cash in a time like this. So I'm going to stop there and move on.
Perfect. Well, thank you. Yeah, this is John. Thank you, Tiffany. That was fantastic. I guess we're shifting to a very different topic now. And John, kind of this is in your wheelhouse. Can you share some financial reporting considerations and maybe some top and common errors that plans should be thinking about?
Sure. So I think this is going to be an area that really needs to be split into pre-COVID and post-COVID, because a lot of us are still dealing with 2019 and trying to get those finalized and wrapped up. So some of these topics can overlap, and I just wanted to point that out. But I think with the first bullet, where we're talking about plan contributions and suspensions or delays in those, that's one of the first knee-jerk reactions that generally happens, right? In times of crisis and trying to conserve and preserve cash, one of the areas that sponsors generally look to, if it's allowable, is to defer some of these discretionary matches or employer contribution matches. Again, that's something that needs to be considered and put in there. I think one of the impacts of the terminations or partial terminations is an unintended consequence of the COVID situation. We have, partial plan terminations can arise based on IRS information if 20% or more of the workforce is reduced in the current year. So there are unintended from unemployment things that needs to be considered. One of the things is the 100% vesting of employees from a termination is something that needs to occur. I think that when you start dealing with furlough issues, it's something that needs to be considered, and it gets a little trickier because furloughs it depends on how you're recording that and what the plan document says from whether you have a partial termination or not. I think when you start dealing with deferrals and furloughs, really consideration of for how long these furloughs are lasting and whether they can be perceived as terminations is something that needs to be considered and something that needs to look like the matters of a potential termination are existing. From a financial deterioration standpoint, obviously, as Tiffany mentioned, there are disclosures and things like that are impacting it. From a loss of revenues and investments and the likes.
John, I think we may have lost you, John.
Sorry about that. Appears the internet cut out for a minute. Joys of working from home, right?
Yeah, exactly.
Apologize for that. So talking about collectability issues on participant loans is another matter that's important. Obviously, we talked about some of the changes that are occurring with the loans and the loans into the future and some of the deferments. But thinking about collectability on these issues and thinking about the ability to collect from previous loans that existed will probably be an area of concern in the upcoming months and years. So again, that's an area to focus in on. When we deal with fair value of investments and estimates of assumptions and going concern, they kind of go hand in hand. I think this is an area that going concern is not generally an area of concern for most plans because they're established to really continue into the future. But I think the ability to have estimates that are reasonable, if you're having valuations performed, looking at the impact of fair value and losses that are occurring, those are the areas that need to be focused in on and thought about as you proceed with your financial statements. Obviously, we've talked about the adoption of the CARES Act provisions and the amendments that need to be contemplated. As Tiffany mentioned, those do need to be made, I believe, by 2022. So, what direction, what amendments do you want to make and how will they impact your demographics are going to be key areas. Workforce reduction disclosures, again, does that impact any terminations or partial terminations for the organization? Changes in business processes and internal controls is an interesting one. I want to spend a few minutes on that because this could impact both you at the organization, but also at the plan sponsor level or the record keeper levels. What controls are changing as a result of COVID that have been made to certain processes, both on your end and from the TPA end that may impact your participants? It is a very important area and distinction. Are these controls going to be things that are done prospectively? Are these just interim stopgaps or fixes that need to be made during the participation of the work from home? And then finally, just thinking about work from home and remote audits. Again, if you're going through an audit and you're trying to complete that, there's going to be more virtual. So understanding that Teams and Zoom and all these other tools that are available to have walkthroughs completed, to have the ability to speak to the individuals within the plan are going to be important. But more importantly, it's going to be important to really be able to transmit data to others within the organization securely. And then, brings up the issue of cybersecurity and risk for organizations, but also the ability to transmit data to your auditors in a timely fashion. Next slide, please. And one more. So when we talk about DOL findings and IRS findings, I think that there's a host of things that come up in the course of the plans, and I know we listed top 10, but there's probably more than 10 that we can all rattle off. I was looking at a recent survey that had well over 25 of these, and I think that I want to highlight a few of the ones that are repetitive in nature. So when we start with, we just take a step back and think about all the regulations that are occurring, all the compliance matters, and the DOL and the IRS audits that occur in the thousands every year, and understanding the compliance requirements that go with them. You could see that having best practices, having the ability to document these procedures and look for errors that might be occurring is generally an important thing in the context of mitigating these risks and findings. I think that it's a best practice to really make sure you have quality controls and documentation of your controls and record retention policies in place so that you have the information to show as you move forward if you're ever under audit. Unfortunately, DOL errors and findings result in billions of dollars actually from audits and voluntary corrections during the years. So correcting these things timely is an important area. All right, so if we were to start with plan document, again, failure to amend or update your plan document is a recurring thing. There's been tons of changes and tons of things that happen throughout the years. It's an inevitable feature. But are you recording these amendments timely? Are you updating them so that the terms within the document are truly reflective of the participation in the plan? Does your plan document mirror, if you have it, a summary plan document that you provide to participants? Those are all things that are important as you start to consider that. So maintaining copies of all legal amendments, reviewing your plan annually to make sure that you've encompassed all the new laws and regulations, generally a best practice in this area. When you think about the incorrect criteria for compensation, this really is an important area because compensation is generally outlined within your plan document for how it's determined. And when you start thinking about severance and bonuses and all that other information that can occur and the nuances as it relates to the compensation amount and how it relates to ADP or ACP testing or top-heavy testing, you can see where things can start to go awry. So this also happens, it's more problematic for larger corporations that have a number of payroll registers and payroll cost centers. So again, comparing the plan document to your actual cost and compensation information and having adequate policies and procedures in place for that is a best practice. When we relate to timely remittances, again, this has been around, I think, ever since I started, which was well over 20 years ago and probably before that. Late deposits is something that is definitely a common issue. Again, the word of administratively reasonable for when the participant data hits the accounts needs to be taken into account. Generally, it's 2 to 3 days, but they've offered a little bit of a safe haven with some of the correspondence that's been out there from the DOL recently, allowing some flexibility because of the pandemic and the ability. That doesn't mean you shouldn't try to get these in prudently as quickly as possible, but they understand that there may be some delays in the submission. Next slide, please. So when we talk about loans and hardship withdrawals, those generally tend to pop up because of the ability to document the loans, have the paperwork in place from whether it's the promissory note or the loan agreement, and having the information provided on a timely basis, especially when there's defaults or unpaid loans. Reviewing loan policies, understanding how they maintain the applications and how all the way through the end of the expiration of the loan term is generally a best policy. And making sure that on an annual basis, you take a sample and try and ensure that the loans are reflective of what's occurring, that there isn't any instances of default that should be taken into account or collectability issues. From an ABP ACP test, again, just a reminder that failure to comply with that is an issue. You do need to have this done. Typically, the TPAs do this for you, but having a policy to check in with your plan administrators, check in with the compensation numbers, and ensure that the population of employees being utilized and the compensation is appropriate for the matters is a best practice. Likewise, with the top-heavy testing, making sure that a review with the administrator is also being done and that you're providing that information and ensuring that passing is occurring. Filing in the 5500s, again, this nothing new here, must be filed annually. Generally, depending on participant size, you will need to have an audit attached to it in certain instances. Making sure that those are submitted timely and completely is an important step in showing good governance and fiduciary responsibility. So make sure you have a calendar, make sure that you've highlighted the date and plan for any uncertainties that might be occurring in that situation. And then just following up on eligibility requirements, each plan has its own rules for when participants become eligible. And I think it's important that the eligibility criteria really be matched up to the processes, that the enrollment packets are done and delivered in a timely fashion. Next slide, please. Next slide, please. We've covered most of those in the previous. And then just winding up on navigating the risk. We've talked about some of the errors and issues that might be occurring within the plans and things, but really these are just a couple of reminders. Ensuring that segregation of duty and internal controls are done at the organization is key. Making sure that you know your timings and when things are due is very important, but more importantly, having backup plans for when things need to be submitted. We never want to rely on just one person in order to accomplish our goals of meeting deadlines. So I think it's important to have a plan in action in case somebody gets sick, in case somebody is out of the office and isn't available to do some of the filings as necessary. So that's a best practice, as well as checking your plan document on an annual basis. And then finally, just to highlight competent advisors, as Tiffany mentioned, it's important to have the right expertise. And if you don't have it internally, asking the right resources for what you need, whether it's for an audit, whether it's for investments, whether it's for other ERISA attorneys and things like that, is a best practice that should be considered. Next slide, please. And then just finally, I think we've highlighted all these, but I wanted to point out the last one on communication. I think communication is key in everything. I think it's better to over-communicate, especially in times of crises. And I think that having the resources to speak to your advisors on a routine basis, but also speak to your participants is generally the best practice to include. And with that, I think, Alex, we're back to you with a few minutes to close up or Q&A.
Perfect. Thank you, John. That was great. I know we have a couple minutes. Do want to just open it up to Q&A, and we do have a couple questions. I guess one question for you, Tiffany. How do you know if you have an excess revenue account, and what would you do with that money?
Yeah, so first I would ask. It seems like an obvious question, but no, I think that's like the main thing. I can tell you stories of plan sponsors that we've worked with that didn't know that they had one, or more importantly, that there was money already in there. So if you do find that you have an excess revenue account, I guess the next question is what's the balance? And you can use that money for the benefit of the participants. So you can use it to pay for your audit. You can use it to hire an advisor to help you. You can use it for participant education, or anything that has benefit to your plan participants.
Perfect. Thank you, Tiffany. And I guess just one question for you, John. You know, many employers are considering placing a group or groups of employees on furlough. You want to talk about what that actually means?
Sure. So again, as I mentioned, you know, the furloughing of individuals is a tricky area because it can impact partial plan terminations, and really does need to take into account how you're dealing with your plan document. You know, a furloughed employee isn't expected to return to work at some point in time, but as opposed to you know, an actual termination. But there are, you know, this is nothing new from a furlough perspective. You know, industries like hospitality, certain retail have had furlough employees in the past. And so really understanding the notice that you're providing, the length of time, and the ability to avoid any partial termination considerations is really key and top of mind, I would think.
Well, thank you, John. I know we're here at the end of the webinar. I just want to take this opportunity to thank both John and Tiffany for sharing some really great insight on EBP plan considerations and COVID-19. Obviously, two perspectives, one from an auditor and one from a chief investment officer. So I thought it was a really tremendous insight. So thank you both. We also want to thank all of the participants for joining us today. If you do have any questions after the webinar, you know, we do have contact information for the speakers on the slides, so you can, you know, feel free to reach out to the speakers. Thank you again, and have a wonderful rest of your day.